we can, or the promoters can enter into this contract in draft form. In draft form means that they will just negotiate those contracts on behalf of the company, but the contract will only be executed. The contract will only be performed once the company is registered. So they just negotiate the contract, but they will also agree with the third party that this is a contract we are negotiating on behalf of the company. The contract will only be executed, will only be performed once the company is registered. Number two, we said that the promoters can also avoid their personal liability by doing what? By basically including a clause in this particular contract that they can only be held liable up to the time the company is registered. Once the company has been registered with the registrar and the contract is breached, then they cannot be held personally liable. On the other hand, we say that the promoters can also do what? Can basically ensure that once the company is registered, the company enter into a new contract to substitute the pre-incorporation contract. So mean that once the company enter into a new contract with the same third party, the pre-incorporation contract between the promoters and the third party will be terminated and replaced by a new contract between the company and the same third party. And actually we say that is basically known as novation. That is known as what? Novation. So we talked about so many ways through which the promoters can actually be able to avoid their personal liability. And actually we said you need to understand, to remember those various ways through which the promoters can avoid their personal liability. Number three, the other rule which governs this particular contract, we say that the company cannot sue the third party. The company cannot sue the third party in case of the breach. In case of what? In case of the breach. So if the third party breaches this particular contract, the company cannot be able to go to a court of law, take a legal action against that particular third party. Number four, here we said that the company equally, or the third party, that is, the third party cannot sue the company, for the breach. The third party cannot sue the company for the breach. For the breach of what? For the breach of the contract. For the breach of what? Of the contract. So in case this particular contract is the breach, then we are saying that this particular third party cannot be able to do what? Cannot be able to sue the company for the breach of that particular what? Contract. Number five, here we said that the company can do what? Can enter into a new contract. Can enter into a new contract. Contract to substitute. The pre-incorporation contract. The pre-incorporation contract through a process which is called what? Novation. Through a process called what? Novation. So the company, once registered, can enter into a new contract with the same third party, whereby the pre-incorporation contract would be terminated and basically replaced by a new contract between the company and the same third party. Also, on the other hand, we say that the members of the company cannot ratify. The members of the company cannot ratify this contract, cannot ratify this what? Cannot ratify this contract. So the members of the company, maybe once the company is registered, cannot pass a resolution ratifying this contract. So to ratify the contract means that the members cannot ratify this particular what? Contract. So therefore, those are basically some of the legal principles, or basically some of the rules which basically governs this particular contract here, which are known as the pre-incorporation contract. So let's move to the last part of that question, and we are told, describe the common law duties of the promoters. So the question here is asking about part C, common law duties of a promoter. Common law duties of who? Of a promoter. The common law duties of a promoter. Now, remember in this case, what we say is that during the formation of the company, basically we say that the promoters are expected to perform various duties. And actually we say that the duties of the promoters are basically broadly classified into two categories. Number one, we talked about the fiduciary duties. And number two, we talked about the common law duties. The common law duties. So therefore, the duties of the promoters are broadly classified into two. So the question here was asking about the common law duties. But before even we look on those common law duties, recall we said that the fiduciary duties These are those particular duties which arises out of the fiduciary relationship which exists between the promoters and basically the promoters and the company to be formed. Remember, in this case, we said the promoters basically are regarded to be the trustees of the company. They are regarded to be the trustees of the company. So therefore, as a result of that fiduciary relationship, there are a number of duties which are expected from these promoters. Which are those duties? Number one, we talked about the duty to account. We say, if, for example, you're a promoter, you're given some amount of money to do a number of things on company's behalf, you must account. You must explain how you spent that particular amount of money, of which you say that accounting basically has to be honest. You must explain how you spent that particular amount of money, even necessarily support that with the necessary receipt. If you paid a number of items, you paid a number of expenses, support that with a relevant document. So then from there, we also talked about the duty of disclosure. In this case, we said that the promoters are expected basically to disclose two things. One is any secret profit. If you make a profit as a promoter, make sure you disclose that. Number two, the promoters are also expected to disclose any personal interest. If, for example, you have some personal interest in a transaction, in a contract you are entering into on company's behalf as a promoter, you need to disclose that to the other promoters. And finally, number three, we talked about the duty to act bona fide. The duty to act bona fide. We say as a promoter, anytime you are doing something on company's behalf, you must do it in the best interest of the company. You must do it in the best interest of what? Of the company, in the best interest of what? Of the company. So therefore, we talked about those three fiduciary duties, the duty to account, the duty of disclosure, and the duty to act what? Bona fide. So let's now look on these common law duties, the common law duties of promoters, the common law duties of the promoters, common law duties of promoters, common law duties of who? Of the promoters. Now, when we talk about the common law duties of the promoters, number one, we say that these are the general duties. The general duties of the promoters. So these are what? These are general duties. General duties of who? Of promoters. Of promoters during the formation of what? During the formation of the company. Formation of who? Of a company. During the formation of who? Of the company. So, and these duties, we said they include what? We said they include number one, basically to do what? To come up with the company's name. Come up with the company's what? Company's name. So it is basically the responsibility of the promoters to come up with a company's name and have it reserved. And have it reserved. And have it reserved. And have it what? Reserved. Now, the other duty of the promoters, the other duty of the promoters, or that is the other general duty. And I've said that these are general duties. These are general duties. So the other general duty of the promoter is basically to register the company. To register the company. To register the company with the registrar of companies. So it is the responsibility of the promoters to do what? To register the company, with the registrar of companies, with the registrar of companies. Number three is that the promoters here do have the responsibility to appoint the first directors of the company, first directors of a company, to appoint first directors of the company. Number four, we say that they have a responsibility to do what? To meet, or in other terms, to pay the preliminary expenses. Remember, in this case, we said preliminary expenses. These are those particular expenses which are incurred during the formation of the company. Who should pay those particular expenses? It is the founders of the company. That is the promoters. They have a responsibility to pay those particular what? To pay those particular expenses. On the other hand, we say they have a responsibility to acquire basically assets or what? Or property for use by the company. By who? By the company. So they have a responsibility to acquire property or asset for use by who? By the company. On the other hand, we say that if the company which is to be registered is a public company, the promoters do have a responsibility to prepare the prospectus. So we cannot talk about to prepare the prospectus, if the company registered, registered is a public company. If the company to be registered is a public company, the promoters do have that responsibility, basically to do what? To prepare a prospectus. Remember, we say that a prospectus is basically that document, or basically an invitation by the company, inviting the members of the public to do what? To subscribe the shares of the company. The shares of what? Of the company. So that particular prospectus has to be prepared by who? Has to be prepared by the promoters. The promoters have a responsibility of preparing that work, of preparing that particular prospectus. So therefore, those are basically the general duties of who? Of the promoters. And I think that is it, that what was required as far as that question is concerned. That is the question number 5. So let's move to the other question, that is question number 6. In question number 6, part A, it reads, identify the different types of meetings that may be held by a public limited company 8 months. So in that case, we are required to identify, in other terms, to do what? To explain different types of meetings which may be held by a public limited company. Remember, you say that once a public limited company has been registered, has actually been formed, that company may convene, in other terms, may hold different types of meetings, different types of what? Different types of meetings. So question number 6, question number 6, part A, types of meetings that may be held, by who? By a public limited company. So types of meetings that may be held by a public limited company. So I think we talked about 5 types of meetings. 5 types of meetings. Yes, I think we talked about 5 types of meetings. Number 1, we talked about a meeting which is called AGM. The AGM, that is the annual general meeting. The annual general meeting. So remember, I said that the AGM, annual general meeting, this is a meeting which all the public limited companies are required to convene on annual basis. So mean that this meeting here is held on annual basis every year, that a public limited company has to convene this meeting. And actually we say that private companies are not under any obligation to convene these meetings for their members, to hold these meetings for their members. Number 2, we say that these particular meetings should be held before the end of 6 months in the following financial year. Meaning that if, for example, a company is to hold maybe an AGM for 2025, that meeting actually will be held the following financial year 2026, but equally before the end of June. So it is held before the end of the 6 months in the following financial year. And actually we say that this particular meeting is for it to be convened, the members, we say, must be served with 21 days notice. On the other hand, we say those businesses which are transacted in this meeting, we refer to them as ordinary business. Business. And I think we were able to look on the various businesses which are transacted during the AGM. So those businesses include what? Number 1, appointing the company's auditor. That is one of the ordinary business, appointing the company's auditor. Number 2 is electing the directors. Number 3 is basically a declaration of payment of dividends. The other one is what? Is the consideration and the adoption of the audited financial statements. And the other one is about what? Is about consideration and also confirmation of the minutes of the previous AGM, of the previous what? AGM. So therefore, we talked about those as the different types of businesses, ordinary businesses, which are basically transacted during what? During the AGM. During what? The AGM. So the other type of meeting which may be held by this company is something called the EGM, extraordinary general meeting. So extraordinary general meeting, we say that this is any other meeting, held other than AGM, and also what? The statutory meeting. The statutory what? Meeting. And actually we say that this particular meeting here is convened to transact what is called the special business. To transact the special what? Business. When we talk about the special business, we are referring to those particular businesses which cannot be transacted during the AGM. During what? The AGM. And actually we say that this particular meeting here can be convened either by who? By the court upon application. It can also be convened by the directors. Or it can also be convened by the requisitionists. Remember, in this case, I was able to explain who are the requisitionists. The requisitionists are basically those particular members of the company who had requested the directors to convene this meeting, because we talked about certain number of members who may request the directors of the company to convene this meeting. We say once the directors have been requested to do that, they must convene the meeting within 21 days. If they fail to do that, then those members who had requested the meeting to be held, who are now known as the requisitionists, they can go ahead and basically convene that particular meeting. So the other meeting, which can also be convened, in other terms, held by a public company, is something called a class meeting. A class what? Meeting. And actually we say the class meeting is a meeting of a certain class of who? Of shareholders. A certain class of who? Of shareholders. A certain class of shareholders. For example, in this case, we say that if the company has issued maybe the ordinary shares and also the preference shares, we said that the company can convene a general meeting of the ordinary shareholders, or the company can convene a general meeting of the preference shareholders. So that particular meeting is known as a class meeting. And actually we say that that particular meeting is ordinarily held by the company to approve something called the variation of a class rate. Variation of the class what? Of the class rate. When we talk about variation of the class rate, it basically means that this is a meeting which is convened by this company to do what? To approve some changes in relation to some rights affecting a certain class of shareholders. If, for example, maybe the company wants to, the directors are proposing the rate of dividend, the rate of preference dividends, maybe to be reduced from, assuming the company currently is paying 12%, the directors have proposed to reduce that rate of preference dividend, maybe from 12% to 10%. So that one has to be convened, or actually that company would be required to convene a general meeting, not a general meeting per se, but a class meeting of the preference shareholders, whereby the preference shareholders will come in and basically discuss that issue, approve it by a special resolution. So then from there, we also talked about the other meeting which may be held. Let's talk over the board meeting. The board what? Meeting. After we say the board meeting, this is a meeting of the members of the board, is a meeting of the directors of the company. We say that this meeting may be convened anytime. There is no timeline when this meeting should be held. So it may be convened anytime, basically for the director to be able to do what? To transact a number of businesses during the board meeting. And I think also we talked about something called the statutory meeting. I hope you can be able to recall, we said statutory meeting, basically this under the new Companies Act, companies or public companies are not mandated. They do not have any responsibility to convene this meeting. But you said the new Companies Act states that any company which was formed under the repealed Companies Act, under the old Companies Act, it had not convened this particular meeting. You have to go ahead and convene that meeting. But we said under the new Companies Act, Companies Act of 2015, public companies are not under any obligation to do what? To hold that meeting. In other terms, any company which is registered in accordance with the Companies Act of 2015, that company do not have a responsibility to do what? To convene that meeting. So therefore, these are different types of meetings which may be convened, in other terms, which may be held by these public companies. So 8 marks for that. So part B of the question reads, state the rule in 𝐻𝐵 versus 𝐷𝐉𝐻 and explain the exceptions to the rule. The rule in 𝐻𝐵 versus 𝐷𝐉𝐻 and the exemptions and the exemptions So this is a rule which we discussed in this topic of meetings, in the topic of meetings. And actually we say that this particular rule here, the rule in 𝐻𝐵 versus 𝐷𝐉𝐻, basically states that a meeting of a company cannot be duly constituted if attended by one what? If attended by one person, even if that person is attending the meeting in more than one capacity. We said you can attend a meeting in more than one capacity. This whereby you are attending a meeting as a member of the company, and also you are attending as a proxy. You are representing another member. Provided it's only one person who is present, that meeting shall be deemed not be properly constituted. So the rule state that a meeting of a company cannot be duly constituted by one member, even if he or she is attending the meeting in more than one capacity. In more than one capacity, even if that person is attending the meeting in more than one capacity. So attending the meeting in more than one capacity means that he's attending the meeting as a member and also as a representative, as a proxy of another member. So that basically what this rule states. Then from there, we can give the exceptions to the rule. So first of all, what do you mean by the exceptions to the rule? The exceptions to the rule, basically, these are the circumstances whereby the meeting of a company can be duly constituted by one person. So only one person who attended the meeting, but the meeting shall be deemed to be properly constituted, and actually any resolution which is passed in such a meeting shall be deemed to be valid. So which are those circumstances? Which are those instances whereby the meeting of a company can be duly constituted by one person? Number one is what we call the creditors meetings. The creditors meeting during the company's liquidation. During the company's liquidation. Now, if you can be able to recall what we said in relation to the topic of company's liquidation, we said whenever a company is being liquidated, meetings of creditors must be convened. One of the main objective of these meetings of creditors is for the creditors to be able to prove their debts, because we say that if, for example, by the time the company is liquidated, you are claiming you're claiming some amount of money from the company as a creditor. There is an amount of money you have not been paid by that company. You have to prove which goods did you supply to that company. Do you have a supporting document? Which services did you provide to the company? Do you have a supporting document? You have to prove that. So therefore, we said there should be a number of creditors meetings. And now, in this case, we said if a company has got a single creditor, then that is the person who is entitled to do what? To attend those particular meetings and do what? And actually to attend those meetings. So therefore, during the company's liquidation, the meeting of creditors can be constituted. A creditors meeting can be constituted by one person. where the company has got a single creditor. So number 2, we talked about the board meeting. The board meeting of a private company. The board meeting of a private company. Board meeting of a private company. So in this case, we said private companies here are required to have a single director. And therefore, if a private company has got a single director, one director, that is the only person who is entitled to attend the board meeting. And that board meeting, even though attended by one person, the meeting shall be deemed to be properly constituted. Number 3, we talked about what we call as the adjourned meeting. Adjourned meeting. So when we talk about adjourned meeting, this is a continuation of a meeting which was postponed due to lack of quorum. Remember, I said that if, for example, a company has convened maybe a general meeting of members, and the meeting do not have a quorum within 1 hour of the appointed time, within 1 hour from the time the meeting was supposed to start, then we say that the meeting will have to be called off. In other terms, the meeting will have to be postponed, or in other terms, it will have to be adjourned. It will have to be discontinued. We said the company should convene, or another meeting will be held next week, the same place, the same time, unless resolved otherwise by who? By the directors. And actually, all the members will be notified that the meeting didn't take place because there was no quorum, and therefore they are expected to attend the following week. So if coming next week, still one member attend, that meeting shall be deemed to be duly constituted, and actually the meeting shall proceed and transact those businesses which were supposed to be transacted by the members. So adjourned meeting. So then we have number 4. Number 4, we have what is called a meeting convened by the registrar of companies. So the registrar of companies can issue an order requiring a company to hold a certain meeting, and equally in this case, the registrar will still order that even if a single person attend, the meeting basically go ahead and basically transact those particular businesses which the registrar of the companies which the registrar has actually ordered to be transacted in such a meeting. So number 5, we have a meeting convened by a court order. So these are those particular meetings which are convened as a result of an order issued by the court. So in this case, the registrar will equally do what? Will equally not the registrar, rather the court will actually may order as a meeting to be convened, and still order that even if that meeting is convened is attended by one person, the meeting should go ahead and transact those businesses which the court has ordered to be what? To be transacted. To be what? To be transacted. To be what? To be transacted. To be what? Transacted. Yes, automatically this one should be the High Court. This one should be the High Court. This one should be what? This one should be the High Court. Yes, I think we can talk over those 5 exemptions, but also remember we have others. We have other what? Other exemptions. We also have other exemptions. So I think maybe we can just talk over the 5. We can talk of the 5, but remember we also have others. Yes. So let's go to the last part of the question, whereby we are required to define what is a special notice. What is a special notice? What is a special notice? Special notice. Special notice. Now, we say that special notice, basically, this is a notice which must be given to the company by its members 28 days before. So the number of days is very important. 28 days before a certain meeting. For example, in this case, we say if the members of the company intend to remove the director or one of the director in the forthcoming AGM, and maybe replace him with another director, they want to remove the auditor and replace him, the returning auditor, replace him with another auditor. So they must give the company a special notice. So therefore, this is a notice given to the company by members by members 28 days before, 28 days before the day of the meeting, 28 days before, 28 days before the meeting, before the meeting, informing the company, about the intention, their intention to pass a certain resolution. To pass a certain what? Resolution. So this is the notice which is given by the members 28 days before, that is given to the company by the members 28 days before the meeting or before the date of the meeting, informing the company about the intention to pass certain what? A resolution. Equally, we can say that this notice is required for what? Or when should this notice be given to the company? When should this notice be given to the company? Number one is when the members of the company intend to pass a resolution to do what? To reappoint a director who has attained the retirement what? Age. So this notice is required for a resolution to do what? To reappoint a director. A director who has attained the retirement age. The retirement what? Age. And who can be able to recall? We said a director should retire after attaining the age of how many years? A director should retire after attaining the age of how many years? A director should retire after attaining the age of 70 years. The age of 70 years. The age of 70 years. So we said, assuming a director has attained the age of 70 years, maybe in April here, and maybe our company will be holding its AGM, in June. So basically, we said this particular director here, who has already attained the retirement age, is not supposed to retire in April, but rather this director is supposed to notify the company that he has already attained the age of the retirement age of 70 years, and that director is supposed to retire in the forthcoming AGM. In the forthcoming what? AGM. So automatically, in the notice which will be sent to the members about this AGM, the members will be notified that one of the director has attained the retirement age, and therefore he will be retiring in the forthcoming AGM. But in this case, the members of such a company may be happy with the services or with how that director has served the company, and they wish to reappoint him back, despite having attained the age of 70 years. So we said for the members to do that, they must give the company a special notice. They must notify the company 28 days before that AGM that they want to reappoint that director back in the office, despite having attained the age of 70 years. That's why we are saying that this notice is required, number one, for a resolution to reappoint a director who has already attained the age of 70 years. Number two, this notice is also required for a resolution to remove the auditor from office, to remove the auditor. Number three is also required for a resolution to remove the director. To remove who? The director. To remove the director. So therefore, this particular notice here is required for those resolutions. Is required for those what? Is required for those resolutions. Yes. So that is it. That basically what is required as far as those questions are concerned. So what I want us to do is maybe just take a short break of 10 minutes, and then we come back. I want us to look on this other paper. That other paper. I've reshared the paper in the class WhatsApp group. So we come back and basically look on some of the questions from that paper. Yes, so we take a short break of 10 minutes. We come back at 1:15. 1:15. Then we can proceed. Of the purchase consideration was demanding and also it is time consuming. So therefore, if you happen to come across this question in an examination setup, avoid computing this. Even without having computed that, you'll be able to get good marks, basically over 15 marks, without having computed that purchase consideration. So what we need to do basically, we will go straight to crossing of the books of account of the selling company, basically by preparing the relevant ledger accounts. So those are the ledger accounts we require to prepare in Roman 1, the realization, ordinary shareholders salary members account, the preference shareholders salary members account, to cross off the books of account of the owned or the selling company. Then from there, we're going to make the journal entries for the journal entries to open the books of account of the new company. And finally, we prepare the statement of financial position of the new company. We'll be able to see that by using that particular approach, that question you should be able to do it within 30 minutes. You have more than 15 marks. You move to the other question. So therefore, you move to this one to cross off the books of account of the old company. But before you do that, it is important for you to recall what you're told in paragraph 1. The company which is to be restructured is 𝐎𝐶𝐶. This is a company which has been making losses, and this is the company which is to be liquidated. Its business operation, assets, and liabilities taken over by a new company, which you're told will be known as 𝐿𝐻𝐻 Limited. 𝐿𝐻𝐻 Limited. So therefore, this is the selling. In other terms, this is the old company, whereas this is the new. In other terms, we refer to this as what? As the purchasing company, as the purchasing what? A company. So the first thing we need to do basically is to cross off the books of account of Tanga, and we do that by preparing the ledger account we are required to prepare as per Roman 1 of that word question. So we move to, or basically we go straight to Roman 1 of the question, and we are required to prepare the relevant ledger account to cross off the books of account of who? Of Tanga. So part A of the question, ledger account to do what? To cross off books of accounts of who? Of Tanga Limited. So which ledger account do we prepare? The ones which are listed there. The realization account, we're going to start with the realization account. The realization account. Then from there, we will prepare the other ledger account, which is called the ordinary shareholder sundry members account. Ordinary shareholders sundry members account. So we don't have so many entries which we record here. And then from there, Roman 3, we require to prepare the preference. The preference are shareholders sundry members account. The preference shareholders sundry members account. Yes. So basically, we said what we just need to recall is what we record in each of these accounts. And actually, we said when crossing off the books of account of the owned or the selling company, what we do, we go back to the balance sheet, to the statement of financial position of this company, and basically we have to cross off all those particular accounts which had balances and whose balances are shown in the balance sheet or in the statement of financial position. Can we go back to the statement of financial position of this company? The information which we have, or actually the statement of financial position. Now, what we said, we start by crossing off the asset account. You can see under the non-current asset, we have two assets. We have property, plant and equipment, goodwill, and then current asset, we have inventory, trade receivables. Now, we say if you go to the additional information, you'll be able to see somewhere being told, or basically be able to see a note whereby you are told, you are given information about the assets which were transferred to the new company, and those may be assets which were written off. Usually, or in our case, that is in note number 6. Even without reading all the notes, I can see that in note number 6. Can we go to note number 6? We are told the tangible assets were transferred to the new company at the following fair values. Which assets were transferred? They include property, plant and equipment, inventory, trade receivables, and then you're told goodwill was considered valueless and it was written off. So therefore, we go back to the statement of financial position. We have 4 assets, 2 non-current assets and 2 current assets. We know the PPE, inventory and receivables were transferred to the new company. Goodwill was written off. Now, what we said, those particular assets which were taken over or transferred to the new company, we debit them here at the book values. The book values are the values we have in the statement of financial position. But it's also important for us to indicate that our values will be in thousands of shillings. So the assets which were transferred to the new company include the PPE. What is the book value for that? Remember, we said we use the book value or the carrying amount. The book value or the carrying amount are the values we have in the statement of financial position. Not the values we have in note number 7. The values we have in note number 7, we are going to use them when opening the books of account of the new company. So that's very important. So the book value for this is 59,500. 59,500. Then below that we have goodwill. Goodwill is an asset which has been written off. We said those assets which are not transferred to the new company and they are written off. Basically, those assets are supposed to be debited in this account, not the realization, but the ordinary shareholder sundry members account. Goodwill was written off as per note number 7. The value for that is 9,000. So then from there we go to where we have current assets. The 2 current assets as per note number 6 were transferred to the new company. We debit them here at the book value. The book value are the values we have in the statement of financial position, 18,500. And then this one, the trade receivables. The trade receivables is what? Is 14,500. So basically, we are done with the assets. We are done with the assets. So when we say don't skip anything, because For the asset can either be transferred to the new company or written off. Those assets which are transferred to the new company, you debit them there at the book value. Those assets which are written off, debit them there at the book value. Then from there we go to the equity. So for the equity, we have the ordinary share capital. Ordinary share capital. Just a minute. Yes, so we continue. So basically, I've said we are done with the assets. We go to where we have equity. So equity, we start with the first item, which is ordinary share capital. Ordinary share capital, we said, is crossed off to this account and actually should be credited. Ordinary share capital. So ordinary share capital, basically, it should be credited here. And that is basically an amount of 60,000. So then below that, we have 9% cumulative preference share capital. Preference share capital will be crossed off to that account and equally should be credited in this account. It should be credited in this account. It should be credited in this account. The 9% cumulative preference share capital, and that is an amount of how much? Is an amount of 30,000. Then below that, we have share premium. We said any form of any reserve should be crossed off to this account. Share premium and any other reserve, that one should be crossed off to this account. It should be credited here. Basically, we have 30. And then below that, we have accumulated losses. Accumulated losses is still a reserve, but that one, because it's a negative, it should be recorded on this side. Should be recorded on what? On that side. On that side, the accumulated losses. The accumulated losses. How much are the accumulated losses? 27,400. 27,400, like that. So I hope you can see we are done with the items of equity. Then for the items of liabilities, we have the bank loan and the current liabilities. So we must be given some information in relation to this. In most of the cases, we say liabilities, unless otherwise they are transferred to the new company. We must be given some information in relation to that. Like if we go to note number 7 in our question here, we are told the liabilities are non-current and current. The liabilities were taken over by the new company at their book value. So all the liabilities, the non-current and current, were taken over by the new company. So the liabilities which are transferred to the new company, we say they are credited here. They are credited here. We start with the bank loan. We start with the bank loan. So the bank loan is basically 22,500. And then we have the trade payables. The trade payables, which is basically 59. Then we have the tax payable. The tax payable, which is basically 3,000. We have the bank overdraft. The bank overdraft, which is 40, which is 45, which is 45. Now you can see what we have done. First of all, we have crossed off all the accounts which had balances as per the statement of financial position, which is given there. Now, there are two other items I think we said we must always remember to account for here, because the other item which we should compute or basically credit here is the purchase consideration. But I've said don't bother yourself computing that. Ignore that purchase consideration, because if you happen to compute that, you'll consume a lot of time doing this question. It's not a must you have to compute that. You'll be able to get good marks even without computing this. Now, the two items you should always remember to account for is, in all questions for external reconstruction, you'll be told this company which is being restructured had not paid preference dividend for a number of years. So what you need to do, you need to compute the preference dividend in arrears. So this one must be given somewhere in the additional information. You just need to go through those particular additional information. There must be somewhere you're told you're given that information. Where do we have that? I can see it in note number 4. I can see that in note number 4. We are told the preference dividend in Tanga were 3 years in arrears, and the preference shareholders, in fact, we can just ignore that. We just need to know the preference dividends were in arrears for how many years. We are told the preference dividends were 3 years in arrears. That is our interest. The other information is basically for computing the purchase consideration, which we have said we need to ignore. So the preference dividends in arrears, we are told they were 3 years in arrears. How do we compute the preference dividends which were payable by Tanga. We are going to use this information about the preference share capital. The company had issued 9% preference shares, meaning the preference dividend to be paid each year will be 9% of this. That will give us the preference dividends per annum times what? Times 3 years, because they were in arrears for 3 years. Sasa, yes, that basically gives us the preference dividends in arrears for how many years? For 3 years. So let's work out this. So we have 9% times 30,000 times 3. And basically we are getting what? We are getting 81. So how do we account for this preference dividend in arrears? The preference dividend in arrears, we say they are debited here in that account, and then we credit them in this account. The preference dividend in what? In arrears. 81. 81. The other item we should also remember to account for is to debit the liquidation cost here. The liquidation cost which was incurred in liquidating this company and paid by the old company should be credited here. You should always be given, you should also be given that in the additional information. Let's go to the additional information number 5. I can see it somewhere in note number 5. And you're told the liquidation expenses of Tanga amounted to 8 million and was basically settled by Elewa. So there was a liquidation cost of 8 million. Of 8 million. Now these are the two additional items you should always to remember to account for, and which are not given in what? In the statement of financial position. Now, once we are done with that, you leave, or basically in our case, we are done with the part A. We are done with part A. Basically, that's what you should do in relation to part A. And now, if that question you leave it at that point, you'll be able to see that you can only maybe lose 1 mark or maybe 2, even if we have not computed the purchase what? Consideration. Because, for example, in terms of how this account is marked, this is now the items which will be marked. 1, 2, 3, 4, 5, 6, 7, 8, 9. How many marks are allocated here? The marks allocated here are 8. So the minimum marks you can be allocated. In fact, this is how this account is marked. Any marks allocated here for any 8 at half. Any 8 at half. Any 8 at half. Any 8 ticks. Each tick you get what? Half. It basically means that you need to get 8 ticks here. How many ticks do we have? We already have more than that. 1, 2, 3, 4, 5, 6, 7, 8, 9. So we already have 4 marks there. 4 marks there. Now this one is basically marked like this. Any 4, because the marks are located here at 4, any 4 at 1. Because I think just 2 items which are missing here, the purchase consideration and the realization gain on loss. So 1, 2, 3, 4. You can also see here, we already have 4 marks. We already have 4 marks, and this account also is marked any 2 at 1. So I can be able to share with you the marking scheme. You can be able to see. So in that case, you can see we already have 2 entries. How many marks are located there? 2 marks. You can see within 10 minutes. Within 10 minutes, you should be having those 10 marks with you. You should be having those what? 10 marks with you. Now, once we are done with that, we need to move to the other part of the question, and that is part B. Part B. So what are we required to do in part B? In part B, basically we are required to make the journal entries to do what? To open books of accounts. Books of accounts of who? Of the new company. Remember, the new company is called what? Elewa Limited. So we are required to make the journal entries to open the books of account of the new company. Remember, you said that if you're required to make the journal entries, now, Odiek is asking about, now remember the other question we did yesterday. Now, the double entry for this liquidation cost is debited here, and then the other entry should be in the purchasing company account. Check the other question we did, but you can see we are not required to prepare the purchasing company account. Are we required to prepare that, the purchasing company account? No. So that's why we are not completing that double entry. Sasa? Yes, we are not completing that double entry. But in case it was required, then you have to prepare that and then you credit that amount in that account. Sasa? Yes. So let's make the journal entries. Now, when making the journal entries here, you make journal entries basically for a number of items, which are obvious. So number 1, account for the assets which are taken over. Number 1, make a journal entry for the assets which are taken over at the fair value. Number 2, account for the liabilities. For the liabilities taken over, liabilities are taken over at the book value. Number 3, account for the liquidation cost which was paid. Now, by basically accounting for these three items, you'll be able to score also all the marks here. So account for those three items: asset taken over, liabilities taken over, and the liquidation costs, which were, they don't even bother going through the additional information there, because you can see, we know the assets which were taken over, we know the liabilities which were taken over, we know the liquidation cost which was paid. But maybe you can also peruse through, you see whether there is anything you can account for. For example, I think in note number 8, we can see whether we can make any journal entries here. But basically, let's make a journal entry for those three items. One, we will account for the assets taken over. So we can say assets, instead of giving an addition, we can say what we are accounting for here are assets taken over, the assets taken over at the fair value. So how do we account for these assets which are taken over? Remember, we are doing a journal entry. We are passing a journal entry. Automatically, once the new company takes over some assets, those assets should be debited in the respective asset account. And then credited in the account called business purchase account at the fair value. So the assets which were taken over by our new company, we have those assets in note number 6. So the assets which were taken over, number 1 is the PP. So we are going to debit, that one will be debited in the PP account. PP account at an amount of 55. Remember, values here in thousands of shillings. So we debit PP. Then we the other asset which was taken over is basically inventory. That we debited in the inventory at an amount of 2,200. So then from there we have the other asset which is basically trade receivables. Which is an amount of 14,500. Yes, basically I think those are the three assets from what we have here which were taken over. But there is something also you must be able to recall. If you can remember the question which we did yesterday, we say that once this liquidation cost which is incurred by this company, we say it is always paid by the new company. Now, once the new company pay for that liquidation cost, in some questions, not all, you can be told that the new company decided to account for that as a preliminary expense. So if it decided to account for that as a preliminary expense, it basically means that this company capitalized that particular cost, and therefore it recognized that as an asset. And what we say, therefore, you need to recognize that here as one of the assets which was inherited, one of the assets which was acquired from the old company. So what we need to do is to check whether this particular preliminary, this liquidation cost, was it recognized as a preliminary expense. So let's go to the information which we have in note number 6. We are told note number 5. We are told the liquidation expense of Tanga amounted to 8 million and were settled by 𝐻𝐻𝐿. Is there anywhere we are told that this particular cost was to be capitalized or it was to be treated as preliminary expense? Are we given that information? Yes or no? Are we given that information? No. But if we were given that information, then we include it here as one of the assets which was inherited from the old asset. Yes. So then with the total amount, we credit the business purchase account. So with the total value of the assets which were taken over. So we have 55 plus 2,200 plus 14 plus 14,500. So this will give us 89,700. 89,700. Remember, we have already explained there above. We have already explained here what we have accounted for. What we have accounted for are the assets which were taken over. Number 2, we account for the liabilities which were taken over. Liabilities taken over. Remember, the liabilities we said are always taken over at the book value, because we say liabilities are not revalued. We say you cannot revalue a liability. For example, you can see that this company had a bank loan. There is no way you can revalue a liability. There is no way you can do what? Revalue a liability. So how do we account for this? How do we account for these liabilities which were taken over? So what we do is that we debit the business purchase account, we credit the specific liability account. So in our case, from the realization account which we have here, we know that we have how many liabilities were taken over? 4 of them. These liabilities. So we will debit the business purchase account. And then we credit the liabilities account. So we have the bank loan, we have the trade payables, we have the tax payables, and then we have the bank overdraft. The bank overdraft. So let's first of all we credit those accounts. So the bank loan is 22,500. The trade payable is 59, and then the tax payable is 3,000. The bank overdraft is what? Is 45. That is 45. Then we need to get the total, and we debit it in the business purchase. So 22,500 plus 59 plus 3,000 plus 45. And basically that will give us 35. 900. So what have we accounted for here? We have accounted for the liabilities which were taken over. Now then from there, we also have this, and this is something you'll come across in all questions, the liquidation cost, which was paid by the new company. So make a journal entry for that. Liquidation cost, which was paid. The liquidation cost which was paid. A liquidation cost which was paid. Now, this liquidation cost, the liquidation cost which was paid, this one, number one, should be credited in the bank. And then from there, we debit an account called what? The selling company account. So the selling company, remember, is the old company. That should be the journal entry. So we debit the selling company. Remember, the selling company is Tanga Limited. So account, how much is the liquidation cost? The liquidation cost is 8,000. And then we credit the account which is called what? The account, or basically we credit bank. Remember, this amount was paid. We credit bank. We credit what? Bank. We credit bank. Now, once you make those journal entries, I think you can just leave it at that point. How many marks are allocated there? The marks are allocated there are 6. So basically this what will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So the minimum marks you can be given per entry can be half. So meaning that you're required, for example, for you to get 6 marks, you need 12 ticks, each half, and you get what? 6 marks. How many ticks do we have here? We have 11. So you'll get 5.5 to the nearest whole number, that will be 6. To the nearest whole number, that will be what? That would be 6. It basically means that by doing that, you already have all the marks. You already have the 6. Now then from there, we proceed and basically prepare what is required in Part C. Can you see how simple this question is if you use that particular approach? Can you see how simple this question is basically to get those particular marks? Very, very simple. Very, very simple. So you can see already we have 10 marks here. We have 6. So we already have how many marks? We already have 16 marks. So then from there, we basically prepare what is required in the last part. That is the statement of financial position. Opening statement of financial position. Position is at 1st of July. 1st of July 2022. 1st of July 2022. Now, equally here, I think we have so many marks which are free because, like, we know which assets were taken over. So all those are basically free entries here. We just need to post them here. So we just need to have a single column here. We start by recording the non-current assets. So the non-current assets, we record the assets which were taken over from the old company, from the selling company. And remember, you said that we record those particular assets here in the books of accounts of the new company at the fair values. So these are the assets which were taken over here. So we start with the PPE, property, plant, and equipment. This was taken over at a value of 55. Maybe the other item you can also include here is the preliminary expense. If the liquidation cost, which was paid by the new company, was capitalized, or in other terms, it was treated as a preliminary expense also included there. But in our case, you can see it was not treated as preliminary expense. Then from there, we move and basically we record the current assets. Now, for the current asset, I think we have these two. Inventory. Inventory basically is this value 20,200. What about receivables? And receivables, basically that one will also not change. 14 what? 14.5. Automatically here we may have other assets like the bank balance and so on, but no need of even computing the bank what? The bank balances. No need of even computing what? The bank balances. Then from there we move and basically record what? Record equity. Now for equity, I think we can be able to get this because in note number 1, can we go to note number 1? We are told that the ordinary share capital of 𝐻𝐶 Limited, which is the new company, is shillings 100 million. That is the ordinary share capital, comprising of 10 million shares of shillings 10 each. So then, basically what we know is that some of the shares were issued by this company to pay the purchase consideration. There is some information which we have in note number 8. Note number 8. In note number 8, we are told 𝐻𝐶 Limited, which is basically the new company, issued for cash and at par all the remaining ordinary shares not issued as part of the purchase consideration. The proceeds from the issue were used to pay the bank loan. So the bank loan will not appear here because you can see it was paid. But in this case, can we be able to compute the ordinary share capital of the new company? Yes. The ordinary share capital of this company will be equivalent to the registered because we are told in note number 8, those shares which were not issued by the company to pay the purchase consideration, all of them were issued for cash and at par. So basically what that means is that the share capital of this company will be equivalent to the registered share capital as per note number 1. The registered share capital of this company as per note number 1 is 100 million. Is 100 what? Million. That will be the share capital. Then from there, non-current liabilities. Non-current liabilities. So this company, I think the obvious non-current liability we can have is the bank loan, but basically we are told this bank loan was paid. It will not appear here. It will not appear here. Then from there, we record the current liabilities. Now, for the current liabilities, we have these current liabilities which were taken over, 3 of them. So automatically, this bank overdraft was paid because there was money which was received. So that one was paid. The bank loan was paid. Maybe you can just check whether we have any other information about the 2 other liabilities. The trade payables, the tax payable. And I think there is no information yet we are given about the payment of these 2 liabilities. They will appear here. So we have trade payables. Trade payables is basically trade payables is basically 59, and then we have tax payable. Tax payable, we have what? We have 3,000. We have 3,000. So now that question, that is part C, equally debate at that point. Equally debate at that point. Debate at that point. So how many entries do we have here? 1, 2, 3, 4, 5, 6. Even if, for example, you're given half, you can see you'll be having how many marks? You'll be having 6. You'll be having 3. You'll be having 3. But I don't think they can give half because how many items may be missing here? This one bank, maybe goodwill. Those should be 2 items. Those should be 2 items. 2 items. Yes, I don't think they can mark it at half. Maybe it was marked at 1. So I've said for the bank for this ordinary share capital, see what you're given in note number 8. In note number 8. In note number 8. In note number 8 and also note number 1. So in note number 1, you're given the ordinary share capital 100 million. And then you're told in note number 8 that there are some shares which were issued to pay the purchase consideration. And therefore, the shares which were not issued to pay the purchase consideration were issued for cash. By the end of the day, our company had issued all the shares. Our company had issued all the 10 million shares, each share having a par value of 10. That's basically why we are arriving at the share capital of this company as 100 what? As 100 million. As 100 what? Million. Sasa? Yes, as 100 million. As 100 what? A million. So basically, that's how we should approach that particular question. How we should approach that particular question here. And basically, by doing that, you should be able to get over 15 marks. Over 15 what? Marks. So using that particular approach, you should not take even more than 40 minutes to do that question. And then I'm saying that you should be able to get more than 15 marks. So therefore, if you happen to come across this question, don't bother yourself computing the purchase consideration. Just use that particular approach. Use that particular word approach there. Now, we have another question there for merger, a question which was examined in 2018. A question for merger. A question for merger. And this is a very, very common area. These are very, very common areas. So what you'll do, you'll also attempt this question on your own using that particular approach. May 2021, there is a similar question to this. May 2021, you do it using this particular approach. May 2021, question number 2. Do that question using the same approach. Actually, if you go to that question, I think you'll be able to see that the requirements are almost the same. We're required to prepare those accounts to cross off the books of account of SWARA and then the statement of financial position. So this question does not require the preparation of what? Of the journal entries, basically to open the books of account of the new company. But let's go to that question for merger. There was a question there for merger. Yes, November 2018, question 2. November 2018, question 2. November 2018, question 2. November 2018, question number 2. November 2018, so you are there, please confirm. November 2018, question number 2. Yes, can we take a small breather of 5 minutes before you look on this one? Do we take a small breather? Yes, let's just take a small breather. We come back at 9:05. We continue. 9:05, we come back. We continue. Yes, so let's continue. I hope you are back. Are you back? So that we can continue. So please confirm whether you're back. Confirm whether you're back. Confirm whether you're back. Okay. So I want us to go to this question for November 2018, question number 2. This basically is a question for merger. And let's go through the question. We see what we are told. The question reads, B Limited and H Limited are private liability companies operating in service sector. They have been reporting successive trading losses for several years, principally due to severe competition, which has put downward pressure on their revenue. So the directors of the two entities, who are also the main shareholders, have unanimously agreed to wind up the company's respective business and amalgamate them into a new company to be named as S Limited with effect from 1st October 2018. So we are given the statement of financial position of the two companies as at 30th of September 2018. That is B Limited and H. What do we have there? We have the non-current assets, which comprises of the PPE. We have the intangible assets, which are copyright. We have the current asset and the total asset. We have equity, which comprises of ordinary share capital, 7.5% cumulative preference share premium, and then we have losses. Then we have non-current liabilities, which comprises of 10% debentures, and then we have the current liabilities. Current liabilities comprises of trade payables and the bank overdraft. We have additional information about all the way to note number 10. So then what are we required to do here? We're required to prepare the foreign ledger account in columnar format. I'll be able to explain what you mean by that. To cross off the books of account of B Limited and H, realization account, preference shareholders salary members account, the ordinary shareholders salary members account. Part B, we're required to make the journal entries in the books of account of S to record the transfer of assets and liabilities we are told to ignore narrations. So then part C, we are required to prepare the opening statement of financial position of the new company. Now, this one is basically a question for merger, because basically what you are told is that we have these two companies. As per the information we have in paragraph 1, we have these two companies, B Limited and H Limited. These companies have been making losses for a number of years, and therefore we are told that it has been decided by the directors, who are also the shareholders, to weigh up these two companies and their respective business to be taken over by a new company to be known as what? To be known as S. So therefore we have B Limited. These two companies are merging, B Limited and also H Limited. These two companies are merging. Remember, in case of a merger, basically what happens is that the identity of the old companies disappear, and then a new company will be formed, which is known as what? S. So therefore, these two companies, because they are being liquidated, we refer to them as the selling, or basically the old company, the selling or old company, selling or old companies, whereas this one will be the new, or basically what? The purchasing company. Will be the new or the purchasing what? Company. So what we need to do basically is we cross off the books of account of these two companies, B and also H, and then from there we open the books of account of who? Of S. Now, when crossing the books of account of these two companies, B and H, we need to prepare the normal account, the realization, ordinary shareholders, the preference shareholders, and members account. But do we prepare those accounts for individual company? No. So what we do, we prepare a single realization account, but with the two columns. A column for B Limited, a column for what? For H Limited. The same case now to the other account, the preference and the ordinary shareholder salary members account. So therefore, we will go straight to part A of that question. And basically, we prepare the ledger accounts to cross off the books of account of these old companies. So part A, we are required to prepare the ledger account. The ledger account to do what? To cross off books of accounts, books of account of B Limited and also H Limited. B Limited and H what? Limited. B Limited and H Limited. So we will start by preparing the first account, the first ledger account, and that is the realization account. The realization account. Now, this realization account, I've said, we are going to prepare realization account for the two companies. That is basically B and H. So meaning that on the debit side, this is basically the debit side, we will have the details column, and then realization account for B. And it's always advisable to check how the information is given. For example, you can see we're given the statement of financial position for B, followed that with that of H. So also arrange your account like that, B and H. So the details, B and also H Limited like that. So then I think our figures are also in million of shillings. We will come here and we indicate that all our figures will be in thousand of shillings. Yes. So then from there, remember this is now what you require to prepare in Roman 1 of the question. In Roman 1. So in Roman 2, we are required to prepare the ordinary shareholders, salary members account. Also, we prepare this for the two companies, that is basically for B and also who? And H. B and H. B and H. So we have the details column, B Limited and H Limited. So the details are B Limited and H Limited, like that. Yes, and then next we have Roman 3. Roman 3, we have the preference shareholders. The preference shareholders, salary members account, salary members account. The format is the same. Details, and then we have B limited, we have H limited. On the credit side, the same columns, details, B limited, and also H limited. The values are in thousands of shillings. The values are in thousands of shillings. Are in thousands of shillings. Sasa, like that. And let's assume, for example, in this question, we also require to prepare the purchasing company account. So basically, no much entries we can be able to make in that account, because majorly what we record there is the purchase consideration. But let's also prepare that account. We see what we can record with in that account without necessarily or without having computed the purchase consideration. So what do we record in this account, which is called the purchasing company account? The purchasing company in our case is S limited company account. And remember here, purchasing company is 1. So therefore, we are not preparing for B, we are not preparing for H. The purchasing company is what? Is S. Yes. Now, having that, I think what we need to do is basically remove and prepare this particular account. Let's proceed and prepare these accounts. And remember, we prepared this account basically to cross off the books of account of the 2 old companies. So what we do, just like what you have done in the other question, we go back to the balance sheet of these 2 companies. The balance sheet of these 2 companies, B and H, we start with crossing off the asset account. So we have a number of assets there. We just need to know which assets were taken over by the new company, which assets were being written off. So that information I can see it in note number 8. So we are told that tangible assets were taken over by S at the following fair values. The assets which were taken over include PP, current asset. Now, you can see, I think in the balance sheet, we have how many assets? PP, we have intangible asset, which is copyright, and then we have current asset. We must be given some information about intangible asset. What is happening to the intangible asset? Because intangible asset is not one of the assets which was taken over. Now, that information, we have it in note 7. In note 7, you're told the copyright of B, which is basically the intangible asset, expired upon amalgamation of the old companies and therefore was to be written off. So therefore, the copyright, which is the intangible asset, was to be written off. So therefore, starting from where we have the asset, the PPE of the 2 companies were transferred to the new company. So we need to debit them in this account at their book values. The book values or the carrying amounts, these are the values we have in the balance sheet. So the PP of B, 16,500, the PP of H, 12,000. So then from there we have the intangible asset. Intangible asset, this one was written off. So being an asset which was written off, we basically debited here intangible asset, and this is only for B, 84. This company didn't have intangible what asset. Then from there we have current asset, and current asset we are given the total. As per note number 8, current assets were taken over by the new company. So being assets taken over, we debit that here, current assets, which is how much? 52,500. And basically how much? 30,000. That's basically what we have there. Then we go to equity section. In the equity section, we start with the ordinary share capital. So the ordinary share capital basically will be credited in this account here. Ordinary share capital. Ordinary share capital for the first company is basically 30,000. For the other company is what? Is 16,000. Below that, we have preference share capital. Preference share capital is crossed off to this account. So we need to credit this account. 7.5% preference share capital for B. This one is 10,000. This one is what? 24,000. So then below that, what do we have? Share premium. All the reserves should be crossed off to this account. Basically, we credit that to this account. The share premium. The share premium for B is basically 16. The share premium for H is what? Is 1,400. And then from there, we have the losses. Losses should be debited in this account. So we refer to them as accumulated losses. Accumulated losses, we have 23,400. And then we have 34,300. Sasa? Yes, I hope you're together up to that point. Then from there, we go to the liabilities. Liabilities, we have non-current liabilities and current liabilities. So what are we told about these both? What are we told about the liabilities? So I think in note number 6, we are told the current liabilities of the old company were transferred to the new company. The current liabilities were transferred to the new company. There is another information which is given with respect to the boards, and that information is in note number 4. The information for both is given in note number 4. We are told the board holders in both companies were settled by issue of by the new company issuing ordinary shares of shillings 10 each to satisfy the nominal value of the boat. So basically the boat which is non-current liabilities, this one was not transferred to the new company, but basically the bond holders were paid. And we said, if you can remember the question we did yesterday, we said that usually the bond holders or the debenture holders are paid their full amount. They do not suffer any loss. That's why we say there is no need of preparing an account which is called, for example, in this case, the bond holders, ordinary shareholders, members account. So that is the bond holders, sundry members account. There is no need of preparing that account because generally this account and this one, we prepare these two accounts to determine how much loss was covered by the ordinary shareholders and the preference shareholders. The bond holders were paid the full amount, so they didn't suffer any loss. Sasa? Yes. So therefore, we will not prepare that account. What we will account for there are the liabilities, the current liabilities. The current liabilities which were transferred to the new company, we do what? We credit them in this account. We start with the trade payables. The trade payables. The trade payables, we have 37,200 for B. For H is 18,400. Then below that, we have bank overdraft. We have the bank OD, which is 2,000. And basically what? 15. And what? 15. You can see we have crossed off all those particular accounts. Then we have said we must always remember to account for two additional items which will not be part of the balance sheet. One of it is the preference dividend in arrears, and number two, the liquidation cost which was paid by the new company. I think we can first of all account for the liquidation cost. This one is in note number 9. I can see it in note number 9. We are told the liquidation expenses of B and H amounted to 8 million and 5 million respectively, and were paid by S Limited, and S Limited treated this as preliminary expenses. Yes. So the liquidation cost, which can also be known as the dissolution cost, paid by the new company, that one we have said should be debited in this account, and that is 8 million and basically 5 million. And then we have said that double entry for this is to credit this account, to credit the purchasing company account. So we have the liquidation cost. So the liquidation cost, you can show which the amount which was paid for B and the amount which was paid for H. Remember, I've said that this account will not be prepared for in columnar format. We have one purchasing company, that is S. So this one is 8 million, and this one is what? Is 5 million. So then from there, finally, we account for what? The preference dividend in what? In arrears. In all questions for external reconstruction, we come across this. So where do we have that information? We have it somewhere either within note 1, 2, 3, 4, or 5. There, somewhere there. So that information is given in note number 2. In note number 2, here, so the preference dividend in B were 3 years in arrears, while in H Limited, while H Limited preference dividend had not been paid for 2 years, including the current year. In other terms, the preference dividends for H were 2 years in arrears. For B, they were 3 years in arrears. How do we compute, or where do we get the information to compute the preference dividends in arrears? You don't need to go back to the balance sheet, just come to this account here. You'll be able to see that the preference shares issued by the two companies were 7.5. So meaning that the preference dividends which were in arrears for B, this company here would be 7.5% of the preference share capital 10,000, and you're told those dividends were in arrears for 3 years. The preference dividend in arrears for H will be 7.5% times the amount of preference share capital 24,000 times 2 years. The dividends for H were 2 years in arrears. Yes, so I'm told this one will be 2250. I hope that one is for B. I hope that one is for B. I hope that one is for B. Yes, that one is for B. What about the other company? That is H. H. Is it 36? 3600? 36? That is 600, eh? That is 600. Yes, that is 600. So we need to account for those deficits here. So for B, 2250. For H, that is 6. So we debit this account and then we credit this, the preference deficit in arrears. So we have 2250, and basically that you got 36. So that part A, you leave it now at that point. You'll have scored all the marks. You'll have scored all the marks. You have scored all the marks because you can see the marks are located here. The marks are located here. Someone is saying my video is not clear. Maybe someone to confirm. Is my video clear? Please confirm. Yes, I'm told my video is clear, Fred. Check on what is happening on your side. Yes, so you can see the marks are located here or 4. So these are the items which will earn you the marks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Even if you are to be given a half, which is the minimum, you have the 4 marks there. So the marks given here are 4. 1, 2, 3, 4, 5, 6, 7. Remember, I said that in most of the cases, this account and this one, the entries are given 1 mark. 1 what? 1 mark. So, but even if, for example, you're given half, 1, 2, 3, 4, 5, 6, 7. So 7 times half is basically 3.5. This should be rounded off to 4. So this one, okay, yes, this one here, the marks are given are basically 4. Usually this one, I've said, this one, for every correct entry here, the marks to be allocated will be 1 for every correct entry, because here we don't have so many entries. Yes. So you can see, by doing that, you already have so many marks with you. And then from there, we need to move and basically answer part B. Part B, what are we required to do? Part B, we are required to make what? The journal entries. To do what? To open the books. To open the books of S Limited. To open the books of account of S Limited. And just like what you have done in the other question, we will basically account for 3 items only. The assets which were taken over, assets which were taken over at fair value, the liabilities which were taken over, and also the purchase consideration which was paid. And like in our question here, we are told no narration which are required, but let's just put some small explanation regarding what we are accounting for your revision purpose. We first of all account for the assets which were taken over. The assets which were taken over here at the fair value. So the assets which were taken over at the fair value, we have said that those assets should be debited in the respective asset account and then credited in what? Credited in the business purchase account. So the assets which were taken over, we have them in note number. We have them in note number 8. The assets which were taken over, the first asset is property, plant, and equipment. So remember this company, that is S Limited, took over assets from 2 companies. Took over asset of B, took over asset of H. But it's obvious that this company will open a single PP account. So the amount to be debited, that should be the total. Should be the total fair value of the assets which were taken over from the 2 companies. So the amount to be debited in this account will be the total fair value we have in note number 8. That is 12.5. And basically what? And 95. And 95, the total. Will that give us 22,000? Yes. So then from there we have the current assets. The current assets, we have 58 plus 38.6. That will give us a total of what? That will give us a total of 96. 96, 600, eh? 96, 600. Is that what you're getting? 96, 600. Yes, give me the total, give me the total, give me the total. So the total current assets. Yes, so 96, 600. Then there is something you have said we always need to check. The preliminary, the liquidation costs, which were paid by the new company on behalf of the old company, were they capitalized? Were they treated as preliminary expenses in the books of account of the new company? Yes. So that information, we have it in note number 9. that the liquidation expenses of B and H were 8 million and 5 million and were paid by S, and they were treated as preliminary expenses. They were capitalized. So we have 5 million plus 8 million, and basically that will give us 13 what? 13 million. These are the assets which were taken over, and then we credit the total in the account called the business purchase account. So what will be the total here? So this will be 131, 600. 131, 600. So total asset taken over. Then from there, we can account for the liabilities, which were taken over. The liabilities which were taken over. The liabilities which were taken over, we have them from we have them in the realization account. These two liabilities, the payables and the bank overdraft. So we have said we debit the total amount in the account called the business purchase, basically with the total, and then we credit the trade payables. The trade payables will be credited with the total amount here. That is basically 37,200 plus 18,400. And basically that will give us a total of 55,600. And then we also credit the bank overdraft. The bank overdraft, we have 2,000 plus 15. And that will give us what? That will give us 35. So the total amount, which now will be 59,100, that one will be debited in the business purchase. Will be debited in the business purchase. Are those additions correct? Are the additions correct? Are those additions correct? Yes, they are. So then from there, we proceeded. Basically, we account for what? We account for the purchase consideration which was paid. Purchase consideration which was paid. Number 3. Purchase consideration which was paid. So the purchase consideration which was paid, we have said that this one will be debited in the account which is called the selling company account, and then credited in what? Credited in the bank. We debit selling company. So selling company, we have two companies, that is B and basically what? H Limited. So the purchase consideration which was paid on behalf of B is 8. Record that separately here, and basically 5 million. And then the total amount, that one should be credited in the bank account. That is 13 what? 13 million. That is the purchase consideration which was paid. Oh, sorry. sorry. I think, no, that one should be liquidation, not the purchase. Sorry for that. The liquidation cost. I think Morimo is moving too fast. Thank you, Cyrus. Yes, that one should be the liquidation. That one should be what? The liquidation cost, not the purchase consideration. Sasa? Yes. So, do we have anything else maybe you can account for here? I think none. So equally, you can leave that part B at that point. At that point, how many entries? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So the marks are located at 4. Even if you're given a half for every correct entry, you already have all the marks with you. Sasa? Yes, even if you are to be given half marks per every correct entry, you'll have scored all the marks. You'll have scored all the marks. So these questions are very, very simple. If you happen to come across this question, should even start smiling. Even before start doing that question, should start smiling, because this is a question you should be able to get over 18 marks. Over 18 marks. So these are questions which is very, very good, simple. So we finalize by basically preparing the statement of financial position. Statement of financial position as at 1st of October 2018. As at 1st of October 2018. So equally, so many free marks are here. We start by recording the non-current assets. Non-current assets. Non-current assets. And in our case here, we have a number of non-current assets, starting with the assets which were taken over as per note number 8. And I think we have already made a journal entry for that. We'll start by recording the PP. And I think the PP have gotten the total, which is 22,000. So that will not change. So then from there, we have current asset. Current asset, we record that down here. But before we record the current asset, we record what? The preliminary expenses, the liquidation expenses which were paid by the new company, but basically calculates. The total is 13. Then from there, we have the current assets. Current asset was a total amount of how much? Current asset was 100 and what? 1 what? Current assets 96 600. Yes. So then from there we proceed and record the other items. Like I think for this particular question here, we can't be able to determine the share capital, because for us to compute the share capital, we have to go back and compute the purchase consideration. And like the other question which you have done, whereby we are told the company had issued all the shares, so which were not issued to pay the purchase consideration, there is no information which are given in relation to that in this question. So it automatically means that in this question here, we can't basically be able to determine the share capital of this company. We can't be able to determine the ordinary share capital. I think maybe what we can record here are only the current liabilities which were taken over. So equally, we don't have any non-current liability. I think we only have current. And it is obvious that this particular bank overdraft will have to be paid, because our company must raise some cash through the issue of the share. So I think what we'll have here is only one, that is the trade payables. And which should be the total, that is 7,200 plus 18,400 plus 18,400, and this will give us a total of 55,600. 55,600, is that what you're getting? Yes, 55,600. 55,600. 55,600. Is that what you're getting? 55,600. 55,600. Yes, and basically these now, I think, are the 3 entries which you get here. 1, 2, 3. 1, 2, 3, 4. Even if, for example, you're given half, you have to be given half. Assuming you have to be given half, you can see still you'll also be able to get 2 marks out of 4. Out of 4 marks, you'll be able to get, should be able to get 2 marks. Now, basically what I've said is that this question, if you happen to come across this particular question, make sure you do that question. You can start even with this question and make sure you get over 15 marks. You make sure you get over 15 marks. Using that particular approach which I've shown you, you should be able to get more than 15 marks. The other thing is that is a question to be done within even 30 minutes. 30 minutes you are done with that question, you get more than 15 marks, and basically you move to the other questions there. Yes, Cyrus, in this question we can't be able to conclude that the share capital of this company would be 120. Because if you can be able to recall the other question, which you have done, there were some shares which were issued to pay the purchase consideration, even in this question, but automatically some of the shares were not issued. You see the reason why the other question we have taken the share capital is equal to the registered share capital is because there was an information that those shares which were not issued to pay the purchase consideration, all of them were issued for cash. By the end of the day, that company had issued all the shares. In this question, do we have such information? In this question, we don't have such information that our company here issued all the remaining shares for cash. That is the difference between the 2 questions. Sasa, that is the difference between the 2 questions. Now, that is it. That basically how we account for this. But you can see this question is a question for merger. But is there any difference between how we account for merger and external reconstruction? You can see there is no much difference. No much difference at all. No much difference. Now, there was another question, although that one, there is a concept which was incorporated in that question. I don't know whether I can, yes, I can guide you. I think we have some few minutes. Let's go to this question here. The question for the question for December of 2022. for 2022. Yes, this one is quite simple. If you happen to come across this question, I'm saying you should always start smiling because these are 3 months, very 3 months, and which you'll be able to earn within a very short period of time. Within a very short period of time, because as I mentioned yesterday, what makes this question to take a lot of time is the computation of purchase consideration. If you decide to compute the purchase consideration, you'll not be able to finish this particular question, and that purchase consideration will not even earn you a lot of maths, but it consumes a lot of your time. It consumes a lot of your time trying to compute that purchase consideration. Can we go to this other question for December 2022? December 2022, and that is question 5. Question 5. Yes, question number 5. This one is a little bit different, but what happens is that in that question, there is a concept which the examiner has incorporated here on compound financial instruments. On compound financial instruments, you'll be able to see that some of these particular questions, in some instances, the examiner may try to test a different standard. Like this question, it was testing a concept on compound financial instrument, IFRS 9. So let's go through this question. We see what you're told. And you're told 𝐻𝐻𝐻 Limited, a private limited company, has been in financial difficulties and has reported trading losses for a number of years. The directors of the company invited the shareholders and the creditors for a special general meeting where it was resolved that the operation of 𝐻𝐻𝐻 Limited be transferred to a newly formed company, which is to be known as 𝐍𝐻𝐿 Limited, with effect from 1st of August 2022. So this company, which is called 𝐻𝐻𝐻, this company will be liquidated. So meaning that this is the old, in other terms, this is the selling company, and its business operation will be taken over by a new company, which is called what? Which is called 𝐍𝐻𝐿 Limited. So basically, this is the new or the purchasing company. Sasa, yes, that is the information which we have. And then from there, we have the statement of financial position of this company, which is called what? 𝐻𝐻𝐻. And then from there, we have additional information number 1, all the way to note number 10. So then what are we required to do here? We are required to prepare the foreign ledger account to cross off the books of account of 𝐻𝐻𝐻. So no much problem with that. No much problem with that, because you just need to do what you have done in the other 2 questions. Now, what I want us to do is there is part B of that question. I think I will not do the entire part of it. Maybe I'll show you part of it, part B. So we are required to make the journal entries in the books of account of 𝐍𝐻𝐿 Limited to record the initial recognition of the 8% convertible bonds and the right issue on 1st of August 2022. Now, in this case here, the examiner, I think, tested 2 concepts here. Something to do with 8% convertible bonds. And remember, we say that if, for example, a company issue convertible debt instrument, what you need to remember very fast is that this is a compound financial instrument. And I hope you can be able to remember, we say that as per IFRS 32, anytime the company has issued a compound financial instrument, e.g. convertible bonds, we say the company should split the 2 components, the liability component and the equity component. Now, that is what the examiner was testing here. You can see that is a totally different concept from the question itself, because that is a concept from a different word. And I think there was some information about what the right issue. Where do we have the information about 8% convertible bonds? Where do we have information about the right issue? I think we will start with the 8% convertible bonds. So where do we have this information about these bonds? This information is given somewhere in note number 5. Given in note number 5. Can we go to note number 5? In note number 5, we are told the bond holders in 𝐻𝐻𝐻 Limited. 𝐻𝐻𝐻 Limited, remember, is the old company. Can we go back to the balance sheet of 𝐻𝐻𝐻? We know that the bonds is part of the non-current liabilities. So this company here had issued 12% bonds 12% boats having a value of 12.5 million. So those are the boats which were issued by the Tahidi. So let's go back to note 5. We are told that the boat holders in Tahidi Limited agreed to be transferred to the new company on the condition that the boats would be converted into ordinary shares after 3 years. And then you're told the coupon interest rate for the convertible boats were 8% per annum. And then you're told similar boats with no conversion rights attracted an interest at the rate of 10%. And then you're told the accrued interest on the boats were to be paid immediately. I think we can ignore that last statement. But basically, what you're told is that these particular boats, which were issued by this company, that is Tahidi, these 12% boats, they were basically transferred to the new company. They were transferred to the new boat company. In other terms, they were taken over by the new company, but they were transferred on which condition? They were transferred to the new company on the condition that the boats will be converted into ordinary shares after 3 years. It basically means that once these particular boats were transferred to the new company, they became 12% convertible boats. That's why we are told they were transferred on the condition they will be transferred into ordinary shares after 3 years. So once they were transferred to the new company, they became 12% convertible boats. 12% convertible. Okay, I think the interest rate also changed, because if you check on the other sentence, we are told the coupon interest rate for the convertible boats was to be 8.
Sure, we are recording. So now we have missed something. But no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time the value of money changes. The value of money does not remain the same. And I'm saying, assuming here now that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this it may be if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year one, you'll receive 300,000. In year two, you're getting 550 or paying or 550. Year three, 600. Year four, 700. Maybe let's say year five, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year one and year two, or period one and period two, we have an annuity of 300,000 because they follow each other. Yeah. But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year one and year three, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see Using tables to find future no, equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. Rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus r power n. So future value is equals to 100,000 times 1 plus 0.2 power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is How much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this, times 100,000. That is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over r. That's how we get the future value of an annuity. 1 plus r, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus r into brackets power n minus 1 over r. This factor here, the factor 1 plus r power n minus 1 over r is called future value, interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. annuity shilling 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 16,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer, get the answer. Three 322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 16. 16. 16. 16. At the end of each period, this person is investing 60. So here you say 1 plus r power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus r. 1 plus r. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We are talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest At the end of year 4, it is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60, at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call, okay, fine, Alice, 080, okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said, this is power 3. because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4, because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that we invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they're saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. 176 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, next 144, 93, 144, 93, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut, but we are doing this method so that you can get the concept, because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting, or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus r power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. Because we are moving backwards. So get the difference. Get the difference. Present value for lump sum is equals to future value times 1 plus r power negative n. So where this is future value, r is we said is the required rate of return. Rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus r power negative n, the factor 1 plus r power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, r% power n. Present value interest factor, r% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value times present value interest factor r% power n. So this factor here, this is r, this is r % power n. Present value for lump sum is equal to future value times present value interest factor r% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment and the required rate of return is 20%. What amount did you receive today to be indifferent using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus r power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor r% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage, or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there at 20% period 3. 20% at period 3 you're getting. Write the factor there 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equal to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equal to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration, present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. No, yeah, question 4B. Question 4B. Question 4B. If you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if